The hotel sector is becoming one of the more interesting real estate stories of 2026, and JLL's latest outlook helps explain why. For the last few years, a lot of investors have been cautious around hotels. Higher rates made financing tougher, valuation gaps slowed deal flow, and many owners were waiting for a better window to sell, refinance, or reposition assets. But heading into 2026, that picture's changing. JLL's view is that hotel investment market dynamics are looking up, and the reasons behind that shift are worth paying attention to if you care about commercial real estate. Let's start with the capital markets side, because that is one of the biggest reasons sentiment is improving. JLL points to stronger debt markets, abundant equity capital, and renewed confidence in the resilience of hotel real estate. In the US, the firm reported that hotel transaction volume reached $24 billion in 2025, up 17.5% year over year. JLL also said that since the Fed began lowering rates in September of 24, the overall cost of debt had fallen by almost 300 basis points, helping investors achieve positive leverage again on acquisitions. That matters. When financing becomes more workable, deals that were sitting on the sidelines start to move back into the market. JLL also reported that global hotel direct investment in 2025 was up 22% from the 2023 trough, with the Americas leading growth at 27%. That's not just a headline about capital volume. It's a signal that hotels are regaining credibility with serious investors. In fact, JLL said hotels accounted for about 8% of global commercial real estate investment in 2025, which is above the long-term average. That tells you capital is not treating hotels like an afterthought anymore. But this is where the conversation gets more nuanced. This is not a market where every hotel asset suddenly becomes attractive. JLL is very clear that performance is uneven. RevPAR growth is moderating overall, and some segments are doing much better than others. In the US, luxury properties outperformed in 2025, while mid-scale and economy saw declines. That's a major real estate signal. Investors are becoming more selective. They're leaning towards assets with stronger demand positioning, better quality, more resilient customer bases, and clearer paths to value creation. That's why luxury resorts, trophy assets, and experience-led hotels are gaining so much attention. JLL says these properties are emerging as top targets because of supply-demand dynamics and institutional appetite for irreplaceable assets. Hotel Dive's coverage of the report adds that ultra-luxury supply is generally growing more slowly than demand, and that high-net-worth travelers remain willing to pay for distinctive experiences. From a real estate standpoint, that means scarcity still matters. If you own or can acquire an asset that is difficult to replicate, the market may reward that more aggressively in this cycle. There's another important layer here, and that is new supply. JLL notes that slower supply growth across major markets should support the performance of existing hotels. The firm said most major U.S. cities have construction pipelines below 2% of existing supply, and that overall new hotel supply growth is expected to remain below the long-term average. That creates a more favorable environment for existing assets because owners are not facing the same level of new competitive inventory. In real estate terms, that can support pricing power, occupancy stability, and the economics of repositioning older assets. Another reason this story matters is who is buying. JLL says private equity is active again, and that high net worth individuals, family offices, and foreign capital are increasingly participating in the space. That diversification of buyer profiles is important because it suggests conviction is broadening. When more types of capital are willing to underwrite the sector, transaction activity usually becomes more durable. Hotel Dive also highlighted JLL's expectation that transactions over $250 million could increase significantly in 2026. That suggests the market is not only healing at the smaller end, it may be regaining confidence at the institutional scale too. Then there are the event-driven catalysts. JLL specifically calls out the 2026 FIFA World Cup and America's 250th anniversary celebrations as meaningful demand drivers for lodging. The firm says that many host cities could see mid-double-digit RevPAR growth in 2026 because of the World Cup's scale and duration. Whether you're an owner-operator, lender, or investor, that matters because temporary demand surges can change asset performance, pricing expectations, and investor appetite in key urban markets. It also reinforces the idea that not all geography will perform equally. Some cities will have much stronger tailwinds than others. Now, none of this means the sector is risk-free. JLL and related reporting still point to uneven market performance and ongoing labor cost pressures in some cities. There are still markets where recovery patterns are slower and operating cost pressure remains real. So the takeaway is not that every hotel deal works in 2026. The takeaway is that the investment backdrop is improving enough that real estate capital is re-engaging, especially where asset quality, location, and repositioning potential line up. So what's the big real estate lesson here? Hotels are reasserting themselves as an investable property type because the combination of better debt conditions, constrained supply, selective demand, and strategic scarcity is creating a stronger transaction environment. This is not about buying any hotel and hoping the market lifts it. It's about identifying the right asset in the right market with the right basis and the right plan. This is why I think JLL's outlook matters. It signals that hotel real estate is moving from a recovery conversation into a strategic acquisition and repositioning conversation. And in commercial real estate, that shift usually gets people's attention fast.